Okay, in today's video, we're going to talk about the difference between an index universal life policy and a whole life policy. I know you've heard quite a bit about them both, and it's super confusing to most people, but I want to break it down in its most simplest way possible. So, when you think about short-term play, I want you to think whole life. Short-term play meaning that you need access to your cash in a reasonable amount of time, like really quickly, within the first year. That's short-term play. That's a whole life policy. Index universal life is a long-term play. You don't need access to your cash anytime soon, ideally 15 years. Okay. That's the first thing you have to ask yourself when you think about which one should I decide to be able to build on. We always want to begin with the end in mind, like Stephen Covey says in his book, The 7 Habits of Highly Effective People, when it comes to policies. Because if you don't begin with the end in mind, you're going to end up being frustrated with your broker when it was really your decision to make. Okay. Now, they partner with you, of course, to make sure that they put you in the right policy type. But the goal is that you have a plan and a vision for your policy before you even purchase it. So if you know you need to purchase your policy to, say, pay off debt, or to use as a bank because you want to try to beat inflation as much as possible, then you need a whole life policy because you need access to your cash frequently. Okay. If you know that you're looking to retire and you want some type of passive income that's tax free, okay, and that's going to basically be able to supplement or replace Social Security, Index universal life is your policy type all day long because it's going to give you more cash in the whole life. And the reason why I didn't even mention anything about a variable so let me just put that elephant out the room. I don't even mention variable universal life policies because you can lose money in those. That's the reason. Anything that you can lose money in, you will never hear Shatika talking about it because we're not in the business of trying to make money off of you and cause your money to be lost. Okay. Our goal is to make sure that you have zero risk. Okay. And you understand with great predictability, what you're going to end up having in terms of your cash value growth. And we have other products. I do a lot with annuities. I love annuities. They work very well for who they work for disciplined people, not wealthy people, disciplined people that can leave their money there to be able to live off the interest. So, but getting back to whole life and IUL. Now, the IUL is going to give you a lot more death benefit for the same premium. Okay, so let's be clear about that. Whole life is a lot more expensive. You can structure them both to be able to be paid off in a certain amount of time. Most people pay on a whole life, all of their life. It's literally like, that's why it's called whole life. You're going to pay on your whole life in most cases because most people can't afford to shorten the amount of time. For example, you can do what's called a 7-pay. That is the shortest amount of time you can have a whole life policy for 7 years. You can do a 10-pay for 10 years or a 20-pay for 20 years. But those are just time frames. But the average individual will complain and they'll just say it's too expensive. So they end up doing the whole life and paying on it their entire life instead of sacrificing a few years and being done with it and having a paid up policy. All right. That's one way that you can do it to pay up your policy. Or you can have what's called a term policy that sometimes come with the ability to have what's called return on premium. You can get all your money back, or you can have a paid up policy from a term policy as well. Those are the two ways that you can pay up your policy. All right, and be done with it. Now, getting back to whole life and IUL. Your whole life is going to be, again, paid on your entire life. It's going to be the most expensive of the two in terms of how much death benefits you're going to receive. You will have, generally speaking, a fixed rate, and maybe it's a participating whole life carrier. Well, you'll be able to get dividends, but those dividends are not guaranteed. And I think people put too much stock into dividends, paying, and in good economy times, those are great to have, but in also good times, they're not going to do you any good because you're not going to be able to receive the benefit of the dividends because the economy is not where it needs to be. So when you think about whole life and cash value, it is slower growth, generally speaking, than an index universal life. Historically speaking, we know that past results don't equal future results, but historically speaking, an index universal life is going to run circles around a whole life over a long period of time. Okay, why? Because in the beginning years of the IUL, there's so many surrender charges and expenses, right? And fees. They're much higher in the beginning years of an index universal life than it is and a whole life. That's why a whole life gives you more access to cash, because you don't have all those fees. All right. The IUL, they're basically saying we're going to take our money up front, because we know that long term we're going to be able to produce you a result that's going to give you that income that you desire, tax free, for the rest of your life if you desire it to be. Some people don't design it that way. They just want to have access to cash when they need it for emergencies. But nevertheless, it will outpace in terms of how it grows cash value wise over a whole life all day long. All right. So that's why people like those. The other negative I would say about an IUL versus a whole life is that an IUL, you can more easily lapse your policy if you're wanting to be taking out a whole lot of loans versus a whole life, because what happens with the IUL is because of the fees and everything, you start to take those loans out. If you do not replenish that money back and you're upside down in terms of your cash value, you don't have any cash value in your whole life, you are going to lapse your policy. Okay. Let's say, and this has never happened, you have 3 consecutive bad years in the S&P 500 and your policy doesn't make any money and you're taking out all these loans, your cash value isn't growing, you're going to end up lapsing unless you have what's called a no lapse guarantee rider added to your policy. And even then, those have a statute of limitations, right? Like they have a certain amount of years that they actually expired. And generally speaking, you do have very few policies out there that may have that the entire time as a rider. But yeah, you want to make sure that you have that rider, and you need to understand what is the period of time that you have a no lapse guarantee, especially if you start to take out loans and that type of stuff. Excuse me. So index universal life is certainly the way to go if you are looking long term to build cash and you want to access cash, say in your latter years, because you never know, you may have to replace your roof, you may have to purchase a new car or whatever the case may be. But for emergency purposes, you have access to cash, more cash in your IUL than you will your whole life all day long. Now, the whole life is good that it's great that it has the guaranteed death benefit, right? Versus, as long as you make sure that you make your payments, as long as you're making your payments, you will have a death benefit. No concerns there, no matter what happens to the economy. And generally speaking there. All right. So those are kind of like the main, overarching high level view, ways that those two different policies, those policies are different, and why people use them the way that they do. An index universal life does not have to be used for a retirement plan, but it could be used for a plan where you need to add, a lot more term into a permanent product. You can mix some term inside there, and it comes automatically with living benefits where the whole life doesn't. Generally speaking, you would have to add the living benefits onto a whole life policy in order to have it there. The IUL normally comes with, and it's usually harder to get approved from a health standpoint. If you're not healthy, then you are probably not going to get an IUL. It's harder to get an IUL because of all the benefits that it comes with. It comes with the living benefits. It comes with a lot of different riders. You'll be able to see depending on which carrier, but I'll just explain that the living benefits, if you become critically, chronically, or terminally ill, in other words, heart attack, cancer, stroke, or dementia. Some carriers even have chronic injury. You can actually accelerate or use your death benefit while you're living. So you don't have to, there's no wait there. Okay. Cancer, heart attack, stroke, you need some type of long-term care. A lot of times you can accelerate, but depending on the medical challenge that you have, as long as it's a qualifying illness, you can access your death benefit while you're living to be able to offset. For some people, might need it because they're disabled and they can't work, and they might need to make some mortgage payments and things of that nature because of their illness. Well, they can access their death benefit to do that. So just understand that those are some of the ways that you can use that. If you have any questions, definitely reach out to us. There's so much to these policies, but we just want to give you like a really quick overview of them. I'm Shatika Hasser, helping you to retire before you expire. So if that's what you desire and what you aspire, we are the ones you hire. Our goal is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive. You can reach out to us at shatika.com, or you can, simply just text the words retire to the number 678-736-6496. All right. Have an amazing day. We'll see you at the top.